Good afternoon, everyone. This is Brian Shannon speaking from AlphaTrends.net. Today is Friday. It's the 28th day of June 2013 and the last day of the quarter, last day of the first half of the year. So let's take a look at these numbers. For the week, the markets were generally positive. Gold got smashed down 4.75%, but the rest of the markets were up here today, this week, that is. And month to date, we do still have losses, but year to date, we're still in pretty positive territory for most of these markets. Let's take a look at the S&P 500. Last week, what we had noted was that the market had come down to the 50% retracement of the year-to-date range, and that's also a 38.2% retracement of the November 16th low from last year, was a 38.2% retracement. And in this same area, we have the volume-weighted average price year-to-date. So we were expecting somewhat of a bounce and then perhaps a further sell-off down towards that 154 level. I still think that's possible, but there's been no reason so far to enter such a short position. So let me clarify what we were talking about was the potential for a bounce up to this prior level of support in this general area, and that potentially acting as resistance, and then a continued move lower. Well, let's take a look at the action for the week. For the week, on Monday, we got back above the volume-weighted average price in the afternoon, and from there, the volume-weighted average price for the week is now 159.17. So for the week, the buyers were in control. When we look at the 10-minute time frame, and we have a volume-weighted average price line here, and let me just show you how I draw that here on Realtick. Some people continue to ask which trading platform I use here, and this is Realtick.com. But if I clear this line off that I currently have there, I'll take this, so you can see it's a VWAP line, and it's going to start calculating the volume-weighted average price as I drag the line over. And you can see that today we came down precisely to that level and found buyers. So since the Federal Reserve announcement and when this sell-off began, the average long participant is actually making money because the volume-weighted, the average price that we've traded at is right here at about 159.80. Further, we have this prior level of resistance in here from the last few days and the advancing 5-day moving average. So I think if there's going to be a bearish scenario, which is still something that's quite possible, I believe, is that we would want to see that next week we probably don't get back above about, let's take a look in here at this, the most recent leg lower, a 2/3 retracement of that would take us from the June 18th high to the June 24th low, 2/3 retracement up at about 162. So I think if we remain between 160 and 162, we get a little bit of distribution here, and then if we break back down below about that 160, 159.75, let's call it, and that turns into resistance, then I think we'll see the next leg unfold. But so far, again, I want to repeat that there's no reason to take a bearish position. We have mixed messages. We have this prior level of support, which seems to be acting as resistance. We have a declining 10-day moving average, which seems to be acting as resistance, with a declining 20-day moving average just above. And we've now closed about 6 days in a row below that 50-day moving average. So we still have mixed messages, but we want to be aware of the potential scenarios. And if we see that happen, then I think, again, that a retracement down towards about 150, we were looking at the 2/3 retracement. I'm sorry, back down to about 154 is what would make sense to me. This prior support in here that we had seen in March and April of this year. So that's for the S&P 500. For the NASDAQ, again, for the week we were up. We were up 1.1%. Month to date, though, we're down 2.7 and still solidly higher for the year. But we can see that we did get a big break of this prior support, and this prior band of support near about 71.50 to 72 is, in fact, looking like it's starting to become resistance. Now, I don't like to sell short at a perceived level of resistance. This is potential resistance. So far, we've had one day here, and actually we made a higher high. So if we undergo a little bit of distribution first, then that would make sense to look for a drop and probably below about that 70 3/4 level. Since the Fed, the volume weighted average price in here, you can see that we touched it perfectly right near the open, and that's where the buyers came in, is about just under $71 a share. We also have a rising 5-day moving average. So on this intermediate time frame, it's really indecisive. We have these higher highs and higher lows. We've experienced a good little bounce, and we're into this prior important level of support, which has the potential to act as resistance. We don't know if it will in fact become resistance, but it certainly has the potential to do so. That we have this lower high, and this could this lower low, and this could be a lower high. So if we unfold from here, then perhaps we see some further deterioration in this market, and we could even look at some of these longer term trend lines, such as one that looks like this, or even the last couple years right in here. So the 200-day moving averages are still a possibility, and actually let's take a look at that in the SPY. That's down at about 151 right now, but I still think 154 is the more likely area for us to find some support, as this has been a level of consolidation in the past. So still not looking like it's ready to be shorted, but I think it makes sense to look for that potential scenario. We got our bounce. Now we want to see these markets undergo distribution and potentially get ready for a decline. Now the Russell 2000 actually kind of ruins that a little bit, in that this prior level of support, 96 to 96.50, did not act as resistance. This market got back up into the range of that 96 to 100 level that it had been stuck in for about a month. So the Russell 2000 outperforming, and we can see that in these numbers here, that the Russell month to date is only down a little less than 1%, whereas all these other markets are really down about 1% or so. And year to date, well, we're 15%. But in the last month, it's definitely outperformed, and it is back into, I think as long as this 96 to 96.5 level kind of holds here, then we might see that this market continues to hold up. The volume weighted average price since the Fed is right here at about 96, so adding further importance to that level, as is the rising 5-day moving average. So the semiconductors were up a little bit here, and you can see that we were talking about really 37 to 37.5 as potential resistance. We've got a declining 10 and 20-day moving average. We're stuck under the 50-day moving average, and when we look at that 30-minute time frame, we can see, really into 38, you could call it, potential for resistance, and we could see that here's the volume weighted average price. Again, this 37-ish area looks important, so perhaps some distribution for 2 or 3 days next week, and then we renew lower would be the case for renewed weakness. The case for strength would be, if the S&P can really get above and hold above 163. Otherwise, we're kind of in a little bit of no man's land right now. Financials were down 13 pennies on the day. For the week, they were up 1.7%, down about 2% for the month of June. And this kind of looks like the Russell 2000, in that this prior support, which should have, if you were looking to be bearish, a lot of people were shorting against that level, and that's only a potential level, an area to study closer on a shorter term time frame. So that prior support did not act as resistance in that area, and now we've still kind of got it the same thing in a little bit of no man's land here. If we get back below and probably hold below about 1920 for more than a half hour or so, then I think that we should be able to see renewed selling that maybe gets this market down to the year-to-date volume weighted average price at about 18.5. Let's take a look at Apple. Apple was up $2.75 today, but it's still clearly in a firm downtrend. You're going to start to hear a lot of people call this a double bottom. It's not a double bottom. It's just an area where we're potentially bouncing once again. A true double bottom is measured by A, B, C. So this would be A, this would be B, and this would be C over here. And once we break beyond point B, then it's called a double bottom. So it's a level of potential support. It's still in a solid downtrend. It got stuck at the declining 5-day moving average today. We still have a pattern of lower highs and lower lows on the 30-minute time frame here. So perhaps we're in for a little bit of a bounce. Maybe it gets up to the 10, the 20-day moving average. But you can't take your eyes off of this longer-term chart as well, where we've been stabilizing at a 50% retracement since the 2008 low. It's still reasonable to think that maybe we drop down towards the 61.8% retracement level. Now, I don't think that would happen all at once because we have this prior resistance, which was support, and that looks like it should be a big level at about 365-ish. But if we get a bounce in here, I think it's just that. It's just a bounce, and you don't want to look at it as the bottom. If you want to trade that bounce, that's fine, but the primary trend remains lower in shares of Apple, and any rally is considered guilty till proven innocent. So just like the last time we were under 400, it might represent a good trade opportunity from here, but as far as an investment, I just don't think it makes sense to let go of. We saw a rally in Apple off those lows of 60 points or 15%. To still be holding it today, I think, is just a huge mistake to let go of a 15% profit and experience all that emotion up through there, especially when the stock has been broadcasting weakness for the last month or so, that after this little failed rally attempt, that once it got below that 5-day moving average and broke this support, then it's really just been steady selling, and that's what markets in a downtrend are supposed to do. Speaking of downtrends, let's take a look at Apple. Gold. Gold continued, again, it got annihilated this week. Gold was down 4.75%. Month to date, it was 11% so far and 26% for the year. You can call it oversold, just as people did over here, and due for a bounce, and doesn't make sense or whatever. And you can look at today's volume and say, wow, that must be it. That must be the bottom. When you look at the longer-term chart, and if we take a Fibonacci off here, what we've been looking at is the 2008 lows and looking for the potential of a 2/3 retracement down at about 113.50 or so. We're getting close to that level, and it's a level to be aware of, but it's definitely not something that you want to say, okay, that's the area I need to buy. That is support. Gold is like anything else that you trade. It's subject to supply and demand for whatever the instrument is. And here in the case of GLD, you can make the case all day long that maybe people are buying physical gold, but it's not affecting the price of the stock the way that bullion is, and or the futures and the GLD are. So you have to be aware of price action. It's been clearly telling us bearish. I've been talking about this for months, and it continues to be bearish. Any bounce in gold from this point remains guilty till proven innocent. Nothing's going to miraculously change for gold overnight. It's like any other market. If they don't scare you out on the way down, they'll typically wear you out, and it's going to take time to accumulate for new buyers to come in, for burned holders to not be selling on any pop. And meanwhile, the trend is your friend. There's still a lot of great trade setups out there. We talk about them all the time on Alpha Trends, and I'd invite you to come take a trial look at it at alphatrends.net. Thanks for your time, and have a good weekend.